Now let's talk about something else a little bit differently here, but it matters because ultimately, remember I said it's commodity prices and the dollar. Okay, if you can kind of walk through this, I know it's a little difficult to see, but that red line coming across, these are if various central banks around the world, their deposit rates. Okay, so it's kind of like when you and I, if we go to a bank and then we have a savings account or checking account and they pay us a rate on our deposits, these are the rates that these central banks pay other banks who keep reserves at the bank, at their bank. Okay, so the Fed, that red line, flat, basically it was at 25 basis points, and then in December they raised the Fed funds rate and the deposit rate's at 50 basis points now. Okay, but if you look at the other lines, let's look at the kind of bluish line. That's the European Central Bank. Okay, and now that notice, okay, so they've cut several times, and now they're at negative 30 basis points. So if you're a European bank and you're keeping deposits at the European ECB, okay, you're not getting paid, you are paying them 30 basis points to keep your money there. Okay, now they're using that as an incentive, if you will, to say, hey, how about don't keep your money here, why don't you go out and make loans with that money? Okay. Problem is A, there's two things. One, there's got to be demand for loans. Or two, the banks have to be in a position from a capital standpoint to be able to say, yeah, we can go out and make new loans. And in Europe, you got a little bit of both. But in either case, that's trended down. They're at 30 basis points. The next line is Sweden. So Sweden Central Bank, they're at negative 35. The Swiss Central Bank is at negative 75 basis points. Okay? A couple of weeks ago, what did the Bank of Japan do? They're now negative 10. So now you've got the Bank of Japan, you have the ECB, there's a couple of other we can put in there, but they all have negative interest rates, okay, that they're paying from there. Now, we can talk about, okay, later if you want to, but okay, well, what are the implications of that? Okay, because that's, you know, if you asked economists a decade ago, they would tell you that these negative interest rates are theoretically impossible. Okay, not possible to do this. And now what we see is that in actuality, in reality, it is possible. Okay, and they can persist and they can stay at these levels. Okay, but so the implication is, though, for this slide, is that you have the Fed diverging, okay, from all these other areas. Fed raising rates. These other ones are having not just cutting rates, but negative rates. So what would be the incentive there? Okay? And what is the equalization? What is the clearing mechanism? It's this. It's the US dollar. It's the currency rate. Okay? If you're going to have to pay to keep money in Europe, well, the other thing, instead of making loans, you may say, hey, you know what, instead of that, how about if I take my euros, or if I take my yen, or I take any of these other currencies and say, you know what, why don't I go over here where they actually have higher rates? And so you do that, the US dollar, the value of the dollar goes up. And that is what we saw driving this rather significant move up in the market. I mean, the value of the dollar. Okay? And so depending on how you want to measure, you may say, well, look, well, why does that matter? Okay, from there. Well, think about this. Again, always relating it back to earnings. Okay? Is that depending on how you want to measure it, you've got roughly, you know, the S&P 500, approximately 40% of revenues come from outside the U.S. And as that dollar appreciates, then the dollar value of those earnings are actually going down. So this dollar, whether or not it keeps going up, now we've seen it kind of been relatively stable here of late from that, but if that continues to move up, then that remains a headwind for earnings, okay? And those are the two biggest variables, okay? Again, commodity prices, crude oil, and the dollar, okay? And in terms of earnings expectations. So just kind of that's what we're watching and following very, very closely. The last thing here, and Janet Yellen, actually, I saw before I came in, they had released her text beforehand of her speech, and basically what she's saying, and the market already knew this, because the Fed in December said, yeah, we raised today, and basically we expect to raise rates 4 more times in 2016, okay? And the market was like, good luck with that, okay? The market was like not happening. Matter of fact, coming in here today, market expectations are that the Fed will not raise rates again this year, Okay, it has a less than a 50% chance by December of another rate increase. Okay, and the reason why is because of this. It's called a financial conditions index. Okay, and what it does, it goes out and it looks at things like the dollar. The dollar is one of the variables. It looks at bond yields, but the most important thing that it includes in here is what we refer to as credit spreads, which are basically risk premiums. Okay, and of late, what you have seen is that specifically risk premiums and credit spreads, as investors have become much, much more risk averse, you're seeing those credit spreads move up sharply. Okay, in the high yield market or in the debt market, companies want to go, the spread they have to pay over the risk-free rate has gone up. Okay, and what that represents, and when that line moves up, it means that financial conditions are getting tighter. Okay, and so the Fed is obviously aware of this. And so the title of this slide, if it was on here, it says the Fed's not the only one tightening. And this is what Janet Yellen noted explicitly in her testimony this morning. She said that financial conditions have gotten tighter. Okay, this is doing the Fed's job for them. And not that they want it to, but it is. Okay, matter of fact, that last little run up there is worth about 50 basis points of tightening from the Fed. Okay, so this is one of the things that we have to be aware of because, again, there's other ways for financial conditions to become tighter as opposed to just the Fed raising rates. Okay, so in either case, I just kind of wanted to give you, kind of a survey of the landscape, but ultimately it comes back again to the fundamentals, which are earnings and valuations.